In this section, we'll be discussing TPO charts. TPO stands for Time, Price, Opportunity. What is a TPO chart? A TPO chart is another charting platform that is used in market profile trading. Just like candlestick and volume profile charts, the x-axis plots time and the y-axis plots price, but the opportunities to transact the product are denoted by a moving ticker along the y-axis within each 30-minute period. The 30-minute periods are identified by a letter and unfold each session to create the full visual profile of that session. Here's an example of what a TPO chart looks like for the E-mini futures. A quote from Jim Dalton, one of the fathers of market profile trading, is price advertises, time regulates, and volume confirms or rejects opportunities. So, why the letters? In the days of floor trading, pit traders would need to specify which 30-minute period their trade took place in by writing down the letter of the associated period. When looking at a TPO chart, this lettering system lives on and tells us at what price the security is trading at each specific time by means of a triangular ticker. When a new price is reached during a period, another letter is added to mark the instances of that transaction, and each new letter is a TPO. Here we see the TPOs in one session: A, B, C, D, E, F, G, and so forth. The entire session makes up a TPO profile. Split versus merged profiles. Split profiles are useful for intraday trading as the clear interaction between periods makes uncovering opportunities much easier. With the profile split, you can see how each 30-minute period interacts with one another's highs and lows along with its volume traded throughout that period. Merged profiles, like volume profile, are excellent for seeing a full session's distribution and to see how inventory is being exchanged between sessions. The merged profiles show the entire session's profile, and how each profile interacts with one another is important for getting the full picture in how the market is behaving. Components of a TPO chart: initial balance, single prints, excess high and low, poor high and low. Initial balance, the first 1 hour of the trading day. Think of initial balance as the foundation of the day. A large or wide initial balance typically signifies a ranging day is more likely. It is less likely that it will run significantly to the upside or downside. Here we see the initial balance in each of these profiles, marked in different colors for the A, B, and C profile. Here they are in a merged profile, and here they are in a split profile. As you can see, in a large initial balance, such as this, in one direction shows continuation throughout the day, whereas a wide initial balance, such as this session, is more than likely to produce a ranging day. Single print. Single prints on a TPO chart are price levels with only one TPO running through them. This is typically an indication that the market has moved rapidly through these areas with little volume exchanged and is likely to revisit in the future. Here we see both single prints on the downside, coming from the downside as a tail, and single prints from the upside. In a split profile, you could see that these levels were moved through quickly and never revisited. This is an example of a single print. Excess high and low. An excess high is a high at the top of a range that is marked by a number of single prints. An excess low is a low at the bottom of a range that is marked by a number of single prints. Here we see an example of an excess low and an excess high on a TPO chart marked by the single prints at the high and low of the range. Poor high is a high at the top of a range wherein the excess is less than 2 TPOs or ticks between periods. This is a sign of weak buying strength and is the visual of a strong sell-off which cuts buying momentum. During a session, a trader can typically expect price to retreat from a poor high as it is a sign of trapped longs. If that poor high remains after the session and into the following day or someday in the future, traders can expect this poor high level to be revisited and repaired by breaking and moving higher. Here we see an example of poor highs across 2 periods. A poor low is a low at the bottom of a range wherein the excess is less than 2 ticks or TPOs between periods. This is a sign of weak selling strength and a shutoff of supply. During a session, a trader can typically expect price to bounce from a poor low as it is a sign of trapped shorts. If the poor low remains after the session into the following day or someday in the future, traders can expect this poor low level to be revisited and repaired by breaking and moving lower. Here we see an example of a poor low. A footprint chart is a type of chart commonly used in conjunction with TPO and volume profile that shows the precise trading volume as a bid-ask spread within a candlestick, TPO, or volume profile. The left side of the footprint shows sellers and the right side represents buyers. A key usage of a footprint chart is to determine which side is being more aggressive at each price point and to see where large order blocks are placed. A visual of buyer or seller aggression can be used as a leading indicator for a developing trend, while larger order blocks can be noted as likely levels for future support or resistance. Market orders that hit the bid are on the left side. These are the sellers. And market orders that lifted the offer higher are on the right side. These are buyers. At any one single price level inside of this candlestick, we could see the battle and order quantity between sellers and buyers at each price level.